Overtrading is one of the most common mistakes beginner traders make. Not because they don't understand risk. Not because they lack a strategy. But because they feel an internal pressure to always be involved in the market. And that pressure is not logical. It is psychological. Until that pressure is understood and controlled, consistency remains out of reach. Overtrading is often misunderstood. It is not simply taking too many trades. It is the act of responding emotionally instead of strategically. It occurs when traders confuse activity with progress and participation with opportunity. Being active in the market does not mean you are trading well. Professional traders understand that opportunity is selective. Beginners tend to believe opportunity is constant. This misunderstanding creates unnecessary risk. Overtrading is also driven by the illusion of control. Many beginners believe that trading more gives them more influence over results. In reality, trading more often usually reduces decision quality. Markets do not reward effort. They reward patience, timing, and discipline. The need to act is often a response to uncertainty, not opportunity. There are three primary emotional drivers behind overtrading. The first is fear of missing out. Traders see price movement and feel they must be involved. They enter late, without structure, reacting instead of planning. The second driver is frustration. After a loss, traders feel the need to regain control. They rush into the next trade to compensate emotionally, not strategically. The third driver is boredom. Markets spend most of their time consolidating. Beginners struggle with inactivity. Instead of waiting, they trade simply to feel engaged. None of these behaviors are strategic decisions. They are emotional responses. Professional traders do not trade often. They trade selectively. They understand that patience is not passive, it is an active skill. Each trade must justify its existence within a defined framework. If conditions are not present, no trade is taken. This is not hesitation. It is discipline. Doing nothing is often the most difficult, and most profitable, decision. Overtrading decreases when structure increases. When traders clearly define what qualifies as a valid setup when they are allowed to engage when they must remain inactive, emotion loses its influence. Rules act as a barrier between impulse and execution. And that barrier protects consistency. Without structure, discipline relies on willpower. And willpower is unreliable under stress. If you struggle with overtrading, understand this: the solution is not more market time. It is more clarity. Discipline is not about trading less. It is about trading with intention. And intention is what separates professional traders from beginners.